If you're a homeowner or even just thinking about buying a home someday, you need to hear this. Something pretty big just happened that could completely change the numbers on your biggest monthly bill. Seemingly out of nowhere, the US government made a massive and, frankly, really unusual move in the housing market. And what was the result? Well, look at this number. For the first time in almost 3 years, the average interest rate on a 30-year fixed mortgage actually dropped below 6%. Yeah, you heard that right. It was a sudden, major shift that honestly caught a lot of experts completely off guard. So that's the big question, right? After years of these painfully high borrowing costs that have kept so many people on the sidelines, what on earth just happened? How did rates fall so fast when they've been stuck up high for so long? Well, that is exactly what we're going to break down right now. Okay, so here's our game plan. We're going to start with the headline grabber, this $200 billion directive. Then we'll get into how this whole move sidestepped the Federal Reserve, which is a huge deal. After that, we'll unpack the big debate that's broken out over this. And finally, we'll try to figure out what this all means for you and the future of housing. So let's start at the beginning. What exactly was this move? I mean, this wasn't some new law from Congress or a typical policy tweak. No. This was a direct order, and it was aimed like a laser right at the mortgage market. And here it is, the announcement itself, straight from the source. On January 8th, President Trump posted this on Truth Social, saying he was instructing his representatives to buy $200 billion in mortgage bonds. The goal? To force mortgage rates and monthly payments down. And notice the language. This wasn't a suggestion. It was an instruction. So you might be asking, who are these representatives? He's talking about two huge players you've probably heard of, Fannie Mae and Freddie Mac. Now, it's important to note these aren't your typical banks. They're what are called government-sponsored enterprises, or GSEs. Their whole job is to buy up home loans from lenders, the banks that give you your mortgage. They then bundle those loans into these things called mortgage-backed securities, MBS for short, and sell them to big investors. This whole system is like the plumbing of the housing market. It keeps the money flowing so banks have cash to keep lending. So how does buying a bunch of bonds actually lower your mortgage rate? It's actually pretty simple. First, the directive comes down. Fannie and Freddie are ordered to start buying up these mortgage bonds. Second, when a buyer with $200 billion suddenly enters the market, demand for those bonds skyrockets. And third, this is just basic economics. When demand for something goes way up, its price goes up. And for a bond, when its price goes up, its yield, which is basically the interest it pays out, goes down. And that yield is what mortgage rates are directly tied to. Simple as that. So what does this mean in the real world for your wallet? Well, let's put it this way. For someone buying a $450,000 home, this drop in rates could mean saving around $230 every single month. That's not small change. That's a huge difference that can make or break a home purchase for a lot of families. Now, this is where the story gets really interesting, because this wasn't just about lowering rates, it was about how it was done. This move represents a totally new playbook, one that basically went around the most powerful financial player in the entire country. And to really get it, you have to understand this crazy context. At the exact same time the White House was doing this, the Federal Reserve, the nation's independent central bank, was doing the complete opposite. They were in the middle of a policy called quantitative tightening, which is a fancy way of saying they were trying to slow the economy down to fight inflation. They were letting billions of these same mortgage bonds just disappear from their books each month, which was actually putting upward pressure on mortgage rate. And this really shows you the stark difference. The traditional way is that the Federal Reserve, which is supposed to be independent from politics, manages interest rates for the entire economy. But what happened here? The White House used its control over these GSEs to target one specific part of the economy, mortgages. And they did it using the company's own cash, not by printing new money. This table just lays it all out so clearly. You've got different players, the GSEs versus the Fed. You've got different funding, existing cash versus newly created money, and just look at the difference in scale and goals. The White House plan is a targeted $200 billion shot aimed at short-term relief. The Fed's past actions were in the trillions, with the goal of saving the entire economy during a crisis. These are two completely different animals. So, as you can probably imagine, a move this bold has kicked off a really fierce debate. Is this a brilliant way to solve a real problem for homebuyers, or is it a dangerous move that blurs important lines? Is it a helping hand, or could it cause real harm? On one side, you have critics like strategist Kirill Krylov. He's basically warning that this reintroduces political risk into the housing market. So what does that mean? Well, it means that investors might start to worry that huge market decisions could just flip-flop with every new election, and if they get worried, they might start demanding higher interest rates to cover that new uncertainty. The big fear here is that using these powerful institutions to score political points could actually make the market less stable in the long run. But of course, the administration sees it very differently. Treasury Secretary Besson put it like this. He said the Fed's own policies were creating this counterpressure that kept rates high. So the government was simply using a tool it already had, the massive purchasing power of Fannie and Freddie, to step in, fill that demand gap, and give homebuyers a break. So it really all boils down to this. You've got the skeptics who are worried that this sets a dangerous precedent, that it could mess with the market's natural functions, and that the benefit might not even last that long. And then you have the supporters who argue that housing affordability is just too important. And when other tools aren't helping people, this kind of direct government action is absolutely justified. And all of this has led analysts to give this a name. They're calling it a managed market solution. Let's be clear. This is not the free market doing its thing. This is an approach where a government entity steps right in to steer things toward a specific outcome it wants. It's a pretty fundamental shift in how things are done. Okay, so we've gone through the what, the how, and the why of this whole thing. But let's bring it back to what really matters. What does all this mean for you and for the housing market as a whole? Well, first off, the immediate effect is undeniable. Just look at this chart. Think about where we were this time last year, with rates over 7%, and we're down even from last week. This is real money back in the pockets of homebuyers right now. But, and this is a big but, lower rates are only one piece of the puzzle. The median price for an existing home is still over $400,000. The risk is that if lower rates bring a flood of new buyers into the market, all that new competition could end up pushing these already sky-high prices even higher. There is some good news on the horizon, though. For a long time, we've had this lock-in effect, where nobody who got a mortgage with a super low rate during the pandemic wanted to sell and lose it. But as rates come down, that effect starts to weaken. More of those homeowners might finally decide it's time to move, which could bring more desperately needed houses onto the market. And that really leaves us with the billion-dollar or maybe trillion-dollar question at the heart of all this. We've seen that the government is willing and able to use powerful new tools to try and help homebuyers. But it makes you wonder, where do you draw the line between a necessary intervention and an action that could risk the long-term health of the very market you're trying to fix? That's the question we're all going to be watching play out. You know, for so many of us, the American dream really starts with a front door and a key to our own home. But behind that dream, there's this massive, nearly $13 trillion system of rules deciding who gets a loan and, just as importantly, at what cost. And right now, those rules are at the center of this quiet but really intense battle. The outcome? Well, it could totally reshape what homeownership looks like for years to come. So how are we going to break this all down? First, we'll look at the delicate balancing act that's always happening in the housing market. Then we're going to unpack these new proposed rules and see who stands to win and who might lose out. After that, we'll connect the dots to a much bigger power struggle brewing in Washington. And finally, we'll talk about why this all matters to you. Okay, so at its core, this whole debate really just comes down to one fundamental conflict. Think of it like a high wire act. On one side, you have the goal of making homeownership accessible for more people. And on the other, you have to make sure the entire financial system stays stable and doesn't come crashing down. So that begs the question, right? Is making homeownership accessible to absolutely everyone a risky idea? It's a really tough one to answer. And before we can even try, we need to get a handle on just how huge this market is and who the main players are. The U.S. mortgage market is just colossal. We're talking about nearly $13 trillion. And the biggest player here, by far, is the government. You can see that more than half of all mortgages are backed by what we call government-sponsored enterprises, or GSEs. You've probably heard of them, Fannie Mae and Freddie Mac. They don't lend you money directly, but they buy mortgages from lenders, which keeps money flowing through the system. Then you've got another big slice from government-insured loans, like FHA loans, which are designed to help folks who might not qualify for a typical loan. And this is where you can really see that tension I was talking about. Look at the FHA loans, the ones that are often the only way for people with lower credit scores or smaller down payments to buy a home. They're showing a much steeper climb in what's called new delinquencies. That just means more people are falling behind on their payments. For a regulator, that rising bar is like a giant flashing red warning light about risk in the system.
So, in response to that flashing red light, the main regulator for Fannie and Freddie, it's called the Federal Housing Finance Agency, or FHFA, is proposing a pretty big change to the rulebook for affordable housing.
And here is the absolute heart of the change. The old way of doing things had two very specific targets: making sure loans were going to both low-income neighborhoods and minority neighborhoods. Two separate goals. The new proposal scraps that and merges them into just one single, broader goal, focused only on low-income areas. So you have to ask, why make this change? Well, if you look at the official statement from the FHFA, they point right to their legal duty. Their number one job, they say, is to protect the financial health of Fannie and Freddie. It's all about stability. So the FHFA is essentially making a case that this is just a common sense course correction. They're saying the old goals were too complicated, that they might have pushed Fannie and Freddie to take on too much risk to meet quotas, and that they overlapped with other programs. This new, simpler approach, they argue, will make the whole system safer and run a lot more smoothly. But that's just the regulator side of the story. Critics are looking at this very differently. They're worried that this isn't just a small technical tweak. They believe it's a move that could have a very real, very human cost. And you have to remember, this isn't happening in some kind of a bubble. It's playing out against a backdrop of a really severe housing affordability crisis. I mean, look at this number. Nearly 23 million households that rent are already considered cost-burdened. That means they're spending so much on rent, they struggle to pay for other basic things like food and healthcare. So advocacy groups like the National Community Reinvestment Coalition are raising the alarm. They're worried that having just one broad goal will actually encourage Fannie and Freddie to just buy the easiest, most profitable loans to meet their target. Think loans to higher-income buyers moving into gentrifying neighborhoods. The big concern is that this takes away the specific focus on minority communities and some of the lowest-income borrowers who need the most help. Okay, but this story gets even bigger than just mortgages. This rule change, which seems so technical, is actually one piece of a much larger puzzle about who holds the power in Washington. Yeah, the really crucial thing to get here is that this isn't an isolated event. This new rule is part of a bigger trend, a move towards centralizing more control over our financial system directly in the hands of the executive branch, and away from agencies that have traditionally been independent. And this isn't just some political theory. It's being tested right now at the Supreme Court. There's a landmark case that's all about one huge question. Can the president just fire a governor of the Federal Reserve? You know, the Fed has always been set up to be shielded from day-to-day political pressure. This case challenges that head-on. And listen to this quote from Justice Barrett during the arguments. It just cuts right to the chase. She's asking, what happens to the public interest, to our economy, if these key financial watchdogs lose their independence? We're talking about everyone from the Federal Reserve to the FHFA, the very agency in charge of our mortgage market. The stakes here are incredibly high. So let's bring it all home. After connecting all these different dots, what's the real bottom line? Why should a subtle change to some affordable housing goals matter to all of us? Well, it really all comes down to this core conflict. On one side, you've got the government's argument for a simpler, safer, more stable financial system. And on the other side, you have critics warning that this will come at a huge cost, making housing less accessible, especially for minority communities, all while concentrating more power in one branch of government. This is so much more than just a debate about regulations. It's a fundamental conversation about what we prioritize as a country. And it leaves us with this really big, unresolved question. When we're trying to build a stable economy, who really gets to decide the price of the American dream?